Okay, I think we're live. We will check this in just a moment. I'm here. My name's Dusty Bates. I have Steve Harper on the line here. He's going to go ahead and take us through investing in net lease property, zero or very near zero landlord management assets. These are things like Dutch Brothers and Starbucks, like you see on the screen. Veritas Capital Investment Group is putting us on. Our specialty is multifamily investments transitioning into net lease property. So if you do have any questions after we're done, please do feel free to talk to us. This is pretty much all we do. So without too much ado, Steve, go ahead and take it away.
Thank you very much, Dusty. Yeah, welcome to Real Estate Investor's Guide to Retirement, Investing in Zero or Near Zero Landlord Management Assets or Investments. I'm going to move right along. I'm going to start with the disclaimer. The disclaimer, bottom line on this thing is I can't guarantee anything. We can't guarantee any results. I'm not a CPA. I'm not an attorney. I'm not a financial advisor. What I am is a real estate broker. I've been doing it now for a little over 20 years. And Dusty, I believe you're coming up on your 10th year.
Right.
And we've got a lot of experience specifically in the multifamily and the retail sectors. So what we're going to do on this video is we're going to talk about a lot of things, but what we have right now is a market that we've called a perfect storm. And it probably should be in parentheses right here because, you know, I suppose, it is worthy of parentheses, but there is a perfect storm out there and specifically a perfect storm for those owners who currently own multifamily type properties, whether it be several houses, a duplex, fourplexes, or a small 20-unit apartment complex. This is a great time for all of this, and we're going to go into all this, the details of that into this webinar. I will tell you, you may not see a market like this again. We don't know because our crystal ball, like everybody else's, broke a long time ago. But this is a great time, and thank you guys for taking the time and the patience for our late start this morning. We had a few technical difficulties, so I really appreciate your patience on that. I'll make sure you have my number at the end of this so you can text me if you have any questions or there was something that you missed due to our late start. What I'm going to teach you today is I'm going to teach you how to take a property like this, and we got a property on the left and a property on the right. The property on the right is actually 5 properties. This was a duplex, I believe 1 duplex, 3 single-family homes, and then a 4-plex. And in this particular case, we actually helped. This was one of our clients, and we'll have more details on this slide later on in the webinar. But basically, we were able to exchange these 5 properties that had an annual cash flow of $80,000 a year, net operating income, spendable income, etc. And they were able to 1031 exchange all 5 of these properties into these 2 triple net lease properties, a Burger King and a Dollar General. And I apologize, I'm actually doing this on the porch. There's a little bit of background noise here that I didn't plan on. But that's okay. I will say, as we move forward on this, you're gonna like what we have to say on this. So the perfect time to invest in these assets, and sorry, I got ahead of myself. There we go. The apartment market is incredibly high right now. If those of you who are on this webinar remember, when we entered into 2009 and 2010, this was a time when people were buying apartments and they were getting certain rates of return on them. And what makes this a perfect market and why it's a perfect market to transition from the multifamily sect into the retail sect is very simply that after the last meltdown, or that 2009, 2010, 11, and 12, as we went through all of that, everyone was losing their homes. A lot of people, a lot of Americans lost their homes. They lost their condominiums. And what ended up happening was a lot of investors got very spooked, because when you looked at the world out there, small businesses were closing every day. The ones that were still hanging on were actually months behind on their rent. Economy was slowed. Banks weren't lending. They actually froze lending accounts. So this was a very scary time. And then when all of that happened, everyone thought to themselves the same thing. Well, gosh, people have to have a place to live. And then when they did that, they ended up in a situation where they actually started driving the price up, and the acceptable rate of return that would be accepted on a multifamily investment down, i.e. the cap rate dropped. So the return that you get on apartments is far less than it was 10 and 20 years ago. The answer to this particular situation in this perfect storm market that we're in right now is absolutely, or it can be, exchanging your multifamily property into something like a Burger King, maybe a Starbucks. And what you end up doing is you end up trading this tenant, this guy on the left, for this tenant, this corporation, major billion-dollar corporation on the right. And that becomes your tenant. Now, you know, for some folks, this is a scary proposition. We've talked to many people over the years that are transitioning from the multifamily investments into the triple net lease investments. And all of them end up with similar questions. So we've learned as we've gone. I do want to tell you a little bit about myself and then show you a way to find out a little bit more about me if you'd like. My name is Steve Harper. I'm a commercial real estate broker. I've been working in this field and really under this specialty in one way or another since about 1999. It was very shortly after I entered into real estate that I moved into the commercial side. So I've done many, many properties. We've actually done, Dusty and I have, you know, analyzed, we've invested, we've brokered, we've consulted on, you know, billions of dollars worth of property over the years. If you'd like to see my full resume or my bio, or as well as Dusty's, you can always go to veritascapitalinvestmentgroup.com and our full bios are there, but I'm not going to waste your time with that on this particular webinar. Today's topics, what we are going to talk about on this particular webinar, we want to talk about an introduction to single tenant net lease properties, or if you sometimes see them, NNN properties or net lease properties. And we want to talk about commercial in general and apartments. This is an introduction. We want to talk about an investment strategy to deploy into today's market, into this, what we're calling a perfect storm, which is now in parentheses, and is excellent, that we can, and I apologize for that, but we can take advantage of this great market where everything's kind of happening in the right directions. And we want to talk to you about how to find those single tenant net lease offerings, where to look for them, and how to find the best deals that match your current goals and desires. And a lot of folks that watch this webinar, we've found over the years, the folks that we meet with, a lot of them are in retirement mode. Some of these people have owned, you know, rental houses, investment properties, multifamily properties for the last 10, 15, 20, 30 years even. And they all end up in the same place at the end, because as you know, kind of the way you get out of a property or out of investing in real estate and into something else without paying taxes is really done via death, unless you utilize 1031 exchange. And in utilizing 1031 exchange, you can move it into something else. But those owners often find, what do they exchange into? Because they're really trying to eliminate or reduce at least their management. And even if you have single family homes, duplexes, triplexes, apartments, and these are being managed by professionals, you're still managing the manager, and it's still taking a lot of your time. And a lot of folks are looking to level out their cash flow. They're looking to get something more predictable and more stable, rather than tenants coming and going and paying their rent and not paying their rent, etc. And they're looking to eliminate management. And that's a lot of what's really nice about this great storm that's happening today, is it also could make it kind of profitable for you to do so. So, like I said, a lot of folks, they're very seasoned investors that we work with. They've just never really been in the retail sector, so they don't understand it. Unknown, it's complicated, it seems scary. It's really not. There's just a little bit of new terminology that you've got to learn. You got to learn the red flags. You need to learn what your good indicators are. Everyone wants a good property, but we got to do is we got to determine your good indicators, and then we show you how to apply your good indicators to triple net or even retail properties. And then identify a proper exit strategy. Part of what we like to do going into this with our clients, nothing's cast in stone, but I'm a believer, and I think Dusty's a big believer in the fact that, you know, upon acquisition, you should have an exit strategy in place. It may be a malleable exit strategy, but it still should be in place. So we're going to help you with all of that here today. This training, it is not for everybody. Some of you may want to, you know, leave, because I got to tell you, this is not a get rich quick deal. I picked a great spot outdoors in 78-degree weather. I apparently picked today's flight path. I'm not sure how I did that. This training is not for the get rich quick folks. If you went to one of these seminars and they told you how you can go in there with no credit, no cash, use other people's money, that's really not this side of it. And I have some different opinions about that if we ever want to talk about those. And, you know, you pay attention to what you pay attention to. So this is not a get rich quick scheme, and it doesn't work that way. It's a get rich slow scheme. That's what this is. It's not for you if you're a hopeful investor and you're just hoping to have money and you're hoping to have equity and you're hoping that something happens. That's great, but you actually have to put together some investment to get into stuff like this and then to get into this kind of investing. And it's really not for those people that are looking for that secret magic pill or that magic bullet, hoping that I or Dusty possess some kind of knowledge that we keep as insider knowledge. It doesn't exist, or at least it's never existed for Dusty or myself, and I can say that's for sure. This webinar is for real estate investors that are looking to grow, diversify their portfolio, increase their cash flow, decrease their management, or simply current real estate investors that are looking at all the different options that they have out there. Because this is one niche specialty that we've identified, and the markets are fantastic for this niche and specialty. There are others to go in, and it is for you, even if you're looking at this just to say, hey, I want to see if this is something I might want to do in the future. We absolutely encourage that. This is for folks who own any kind of investment real estate. If you have any kind of investment real estate, you should be looking at this, as well as, you know, a lot of other stuff that's out there on the market, and a lot of other opportunities that are out there, which we're going to show you some great places that you guys can go look for those as well while you're going. And this is for investors that maybe you don't have any properties, but you're sitting on a little bit of cash, and you're thinking about some ways that you can deploy that cash to do more for you than maybe you don't feel the stock market today in this day and time is in a great spot. Maybe you feel like it's going to go down, so maybe you don't want to invest there. This is a great place and a great opportunity in vehicles. So this is something else that it would be for you if you've got a little bit of cash to place. You can exchange your property out of your high management rentals and apartments, and you can exchange those into a Net Leased and a Taco Bell or a Starbucks, a Walmart, assisted care facilities, hospitals, urgent care clinics. A lot of these properties are on triple net leases. And a lot of folks, they say, well, why in the world would Starbucks Corporation lease all their properties? They've got gazillion dollars. Why don't they just own them all? It's a very, very simple answer. It's better for their net cash flow. It's better for their taxation to not own the property. Because if they own the property and they do everything that they need to do in a triple net lease to maintain that property and keep it going, they don't get to write off everything they spend the same year they spend it. But when they're in a triple net lease, which the triple net lease also requires them to maintain the property as if they owned it. And when you do that, the Starbucks then gets to pay for everything the year it happens, but they also get to deduct that against their income, thereby making their net income on selling coffee much higher and a much more attractive return. So basically, it's a tax strategy for all of these big companies, and some are corporate, some are franchise. We get into that in the book, which I'll tell you about, and I'll get you some sources that you can get out to and get some details on that. I'd like to show you a couple of examples of some triple net lease investing moves. Some folks who've done this. Now, if you remember, this is the same as the first slide. I didn't put the purchase price on there. I did tell you that the cash flow was $80,000 on all 5 of these properties that they owned, and they exchanged into these 2 properties. We were able to facilitate that. And if I remember correctly, I think we were able to close on these 2 properties probably within a few weeks after our 45-day ID period, but we were well on the way of closing, I think, by the time we got out of our 45-day period. Now, behind the scenes on this deal, I remember this one specifically. They weren't actually making $80,000 cash flow. That was actually what they should have been making. That was the pro forma. When we actually went in and did our full analysis, because we don't just go into the MLS and have it spit out some kind of price and tell us this is what your property's worth. We actually analyze it. We talk to our clients and we tell them, yeah, if you would change some of your management habits, you might get more money into it. They were making closer to half that. And I don't remember if it was 40 or 50,000 that they were actually taking, but it should have been these properties properly managed, properly taken care of, should have been making $80,000 a year. We did the exchange and they immediately were making $131,612. And let me tell you something, the checks haven't stopped coming that I'm aware of with these particular clients. This was a 20-year lease, and I believe this Dollar General was a 10. So the Burger King I think was on 20. Dollar General was either on 10 or 15 years lease, and this property was probably 3 or 4 years ago. We closed this particular set for a client. Their job has gone from intensive management, managing the manager, one of the family going out and doing the rehab, changing the toilets, getting out what was clogged from the toilet, evicting tenants, serving notices, doing inspections. That all went away. And now their job, their management is 3 things. They have to go to the mailbox, or I don't think they even have to go to the mailbox. I think they have to check their account the first of every month and make sure the wire's gone in for the rent. The second thing they have to do, they have to, twice a year, I think they get notice that the taxes bill came due and that the tenant paid it. And then once a year, the insurance comes due and a new insurance writer comes through. You need to make sure you receive those. That is the management that is now taking place on this particular set of clients who moved from these 5 multifamily properties into these 2 net leased properties. This was another real world scenario. This was a current and dear client. She still is our client. And she had a couple of rental homes and a 4-plex. I think this rental home maybe had some folks in and out of it, but it was really pretty wrecked. This home was almost inhabitable, on the bottom right. This 4-plex, I think it had 1 tenant living in one of the 4 units. The others were all in terrible need of rehab. And you ask yourself, well, how did it get to that situation? That investor must have been irresponsible. No, that investor wasn't irresponsible. The investor was they were already senior citizens. The husband passed away and he had handled all of this. And when the wife received this was not her cup of tea. She didn't know what to do with these or how to do it. So really what happens to folks when they get in that situation, a lot of times they're like a deer in the headlights. They kind of get stunned. So they don't do anything. They don't move forward. They don't move backwards. I was introduced to Margaret by another very trusted close friend who I've done a lot of business with. And I got to know Margaret. And I can tell you, every time I talk to Margaret, which I talk to her every 2 or 3 months, every time I talk to her, she says, Steve, I didn't believe it. I was just hoping that when this Taco Bell thing was all said and done, I would still be making at least $15,000 or $20,000 a year. She said, but you were right. The rent comes every single month, and I receive my income every single month. So I always love stories like that. This is another real world scenario from one of our clients. We had a 16-unit apartment complex. It's a nice looking apartment complex in the picture, but I'll tell you, it was honestly a nice, high functioning, maybe a low B property, very, very clean, not fancy at all. It was not in Palm Springs. It was on the Palm Desert side. We were able to take this one. We were able to sell this for $2,150,000 cash, and it was a very quick close. And we were able to quickly exchange into this other Burger King. And I believe this one in Lincoln is also very close to a college. This one has one of the major universities within, I think, a mile of this property, maybe less. I don't remember, but they went from an 82,000 net income to closer, 130 is where it started out. And by the way, on this one, there's increases every 5 years in the rent. So every 5 years that readjusts up. And I don't remember if this one was 7.5% or 10% every 5 years, but it was one of those two numbers, I believe. I'd have to go back and double check. Don't hold me to the increases, but they do have them. And just a fantastic situation. And because of the perfect storm we talked about, that's why this works. It works because of the market we find ourselves in. Like I said at the beginning of this webinar, you know, when this last downturn happened, everyone threw their money into single family homes, thereby driving those prices up and the acceptable return down. And I had never seen it. At that time, when we were going through it, I was probably 10, 12, 15 years, maybe, I guess, into the 12 or 15 years into my real estate career. But for my real estate career prior to the meltdown, I knew that if someone bought an apartment complex, they would get a much higher return than buying one of these single tenant let lease properties. That was true then. Since the downturn, that hasn't been true. And as these prices go up in California, as California continues in my state, and I know there's some of you folks might be from other states because we do stuff all over the country, but in California, we've also got statewide rent control coming. There's a lot of reasons to look at doing this. I have some investors, their plan, they're not trying to retire out of real estate, but they're also not wanting to leave their money in multifamily because they recognize that we're at a peak. I believe we're at a peak. I don't know it. I can't confirm it. I don't have a crystal ball, but I believe that we're at another peak and we've got another down cycle coming. We're on the cusp nationwide of another down cycle. The difference in this down cycle that's going to be interesting for me to watch is we've never been this high a price in multifamily. We've never driven cap rates down as far as they are, and they certainly hadn't flip-flopped before this downturn where investing in an apartment is actually going to get you a lower return than investing in a net lease property. So I want to go through. So, you know, as we've dealt with lots of clients that are doing this very thing, and, as well as real estate agents. Some of our clients are actually real estate agents that acquire property as they move forward. We've helped them do the same thing. You know what the single most asked question is? The single most asked question is, do I own the business? I don't want to own a Starbucks. I don't want to be responsible for managing a Burger King. I'm not interested in a Safeway. I don't want anything to do with that. No, you do not own the business. You just traded Johnny Bob tenant for corporate or deep pocket guaranteed tenant, and the tenant you're trading for is signing a super long-term lease, and they have to take care of the property like they own it, which is pretty incredible. No, you are the landlord. The business is the tenant. There's a lot of new terminology to learn. And what I want to do is I want to send you guys an ebook. Dusty and I put together a little ebook. And what it does is it covers a lot of the red flags. It gives you a nice overview on single tenant net lease. And it also gives you some side-by-side real world examples of the multifamily versus the single tenant net lease. The following, this is an example. This is some of this. This is from, I believe, not CoStar. This is probably from LoopNet. This is a LoopNet listing. Some of the things that you can look out for on this, you know, if you pull this up, and you guys can all go to LoopNet, you can get a free account, you can get a paid account, you can get a CoStar account, whether you're a real estate professional or not. You're going to need a real estate professional certainly to go through these, but you can certainly look for these yourself as well. So you're obviously, the price on this one, $1,527,000. They're saying this is a 5.5 cap rate, and that generally means out the gate. It's generally a 5.5% cap rate, and then there's going to be increase as it goes. The net operating income on this one, the first year one, is $83,985. Again, the net operating income. That means the tenant has to pay this rent every year in a monthly payment, but they also have to pay all the property taxes when it comes up. They also have to pay all the property insurance when it comes up. And they also have to pay all of the building and property maintenance as it moves forward. And the lease is generally pretty thorough about how they have to take care of that property. And if you read down here where my cursor is, this lease has 5% rental increases every 5 years. This is what I call a super stable investment. And someone that's looking for hands-off investing, hands-off return, this is a nice option, or this is a nice type of property to look at for that type of investor. They want their money hands off, but maybe they're tired of tenants and toilets and evictions and rent control, and they just don't want to hear anymore. This is a nice place to move that. And if you're just waiting for the down cycle, if you are out there and you believe that multi-prices is indeed at the highest price it's ever been at, you want to think about looking at an asset like this. Because if you believe that, I'll tell you something else. The single tenant net lease stuff, it's not as volatile as multifamily. It doesn't have the big ups and downs. Yes, the acceptable cap rate kind of goes up and down a little bit, but it's not near as volatile as multifamily. So if you do believe multifamily is there, you should put yourself in some kind of a program to get one of these 20-year leases, hold on to it for a couple of years, let the market adjust, and then go back and buy yourself back into and back up to the multifamily market. So just a little food for thought there. So again, this is the Dunkin' Donuts. Okay, so what we want to talk about here is some of the things, and by the way, that ebook that I want to send everyone on this, and I'm going to give you 2 different ways to get that ebook before we're done with this webinar. But the ebook's going to go into more depth on this, but I wanted to give you an idea of some of the things you look at. Again, we had to talk about what's a good investment. So here's the Dunkin' Donuts. That's the subject property right here. It's cut out right there. It's next to State Farm, a Subway. Looks like a Jimmy John's. Papa Murphy's is over there. If you look, it's also got a traffic count. Traffic count is the average daily car count, basically, is how many cars per day. And you can get going in each direction. You can break that down. But whenever you see numbers like 29,000, that is extremely, extremely fantastic. There's also this Cross Street has 9,800 cars a day. So obviously that's East 53rd is the main thoroughfare. And then the secondary thoroughfare is this Jersey Ridge Road. So again, those are some great things to look at. But also look at this map. What's around here? Because when you look at this, Dunkin' Donuts has a drive-through. So where are they going to draw their clients from? Well, they're first going to come from all the cars that are driving by, right? That's what's going to happen. Also, these neighboring businesses, I guarantee you these neighboring businesses, anytime you start having packed businesses like this and successful businesses, Chick-fil-A, Wendy's, State Farm, Jimmy John's, Papa Murphy's, these are known areas. And these people employ smart people to figure out where they need to go to do good business. So you're seeing a lot of good attributes to this particular property. You also have these apartments up here, 288 units. I can't really see this one because of mine, but you got another apartment complex up here. And that is all covered in this book, The Real Estate Investor's Guide to Retirement. Again, I said I would absolutely give anyone this book that comes on this webinar. You're more than welcome to get the ebook. If you want to get it, you can get it now. You can get it later. You can go to www.theretiredinvestorbook.com. Or if you want to right this moment, you're welcome to text me at 916-798-1116. And I will only send it to you. I won't do it if you can't follow directions. Otherwise, go on here and follow their directions. If you can follow mine, I'll send it to you personally from my email, the ebook. And all I need is your name and your email address. If you give me those 2 things, I'd be happy to do it. Again, we're not going to sell any of your information. We never, ever sell information. Anytime we have information, these are for our clients and hopefully to be a benefit and another arrow in your quiver of investing. So investing in these real estate markets, I talked about this. This is a perfect time to diversify. Why? Again, I want to reiterate the reason. Number 1, we ran the apartment prices up in the last downturn. Number 2, apartments are now at their all-time high. Number 3 on investing in this particular market, I would say, and I want to be careful about this. Again, I'm a real estate broker. I'm not an investment guy. But if you kind of look at what's happening, the Fed's just lowered the interest rate again. And I believe everything anticipated they would be in raising the interest rates as we go. Now, that's going to happen at some point in time. But again, most of the market experts are looking out there and they're saying, yeah, we've got another downturn coming. We've got another down market coming. So again, another reason to invest in this market, just to park the equity into a less volatile property type while you're waiting for whatever this next market is going to bring. So if you buy it with 10 years left, or 20 years left on a triple net lease, and you sell it with 5 years from now, there's still 15 years left on that lease, and there will be a market for that property. Maybe another reason to invest is to retire or get rid of your headache or your high management properties, the tenants, the toilets, and the trouble. Maybe you just want to trade that for mailbox money. That could be the situation. And maybe you just would really like, maybe you're a monopoly player. Maybe what you'd really like to do is just trade some houses up for a hotel. Well, we would love to talk to you about that. Again, you're trading this John Q tenant. Hopefully this isn't your tenants, but I have met several like this, for this tenant on the right, the Starbucks corporate guaranteed absolute triple net lease. Sell some of those, buy one of those. That is really the niche that we've found. I'm going to give you a couple of quotes and tell you some places you can go to look at it. First of all, you can Google Real Capital Analytics. You can find out a lot of cool, neat stuff. There's also a thing called the National Real Estate Investor Online. Got a lot of great information on there. Here's a quote, and I believe this one was probably from 2017, maybe early 2018. In 2016, the average cap rate for multifamily reached a minuscule 4.7%, a full 50 basis points lower than the lowest cap rates seen in the last expansionary cycle of 2006 and 2007. And let me tell you something, folks. I know a lot of people who have been multifamily professionals for a lot of years in different parts of that world, and they all tell me the same thing. They've never seen, I got 35-year men and women, 40-year men and women that have done this. They say they've never seen cap rates sell. I'm embarrassed. I got to tell you something. When we sold that Palm Desert apartment complex, we sold that Palm Desert apartment complex at less than a 4% cap rate. It was less than 4%. And we exchanged into a lot more than that. This one's very interesting to me. The title of this, the article title of the second one, Multifamily Investors Continue to Accept Low Cap Rates, but for how long? And that was from August 2nd of last year, of 2018. Here's a little excerpt from it. Benchmark interest rates have already risen more than 0.5 percentage point in the last year, and they seem to be rising further this fall. Now, that was true in 18. Now, they've now lowered them, but guess what? It didn't happen. But cap rates for apartment properties just stayed frozen in place. They didn't move. As they raised interest rates, the cap rates did not move. New buyers continue to step forward paying high prices, and I want you to listen up specifically if you're in California right now. If you're in California, how long do you think it's going to take before new buyers continue to step forward with rent control that's now been passed, taking effect January 1, and it's going to get more and more restrictive as we go by? What can I do? What can I do in this market? You can lock in your equity by selling some of your assets, your rentals, your apartments unit at historically low cap rates. You can avoid taxes through a 1031 exchange, and you can acquire a well-placed, well-researched single tenant net leased or triple net leased property. Part of that is what we want to do for you. So an example, what we did is, I think Dusty did this, and then he just gave it to me. He said, I'm going to put this on the webinar. I'm going to find a couple of real properties on the market, and I want you to use those as an example. I believe, and I'm going to ask you, Dusty, did you pull those up last week, the week after, or next week? Not next week. When did you pull these things up? Not next week. When?
Just a couple weeks ago.
Couple weeks. So these were on the market a couple weeks ago. And for those of you who know LoopNet, you can go and look and see if it's still there. It may even show pending. I don't know. Here's one that's being offered actually in Long Beach. This is a 5-plex, so you have to obtain a commercial loan to buy it if you're going to get a loan on it. And they're saying that it's a net operating income of $88,000 a year. Let me tell you something. Seldom do I find that I agree with the expenses when I'm representing a buyer to buy a multifamily property. Many times the expenses ends up being a little more than what they claim, and the NOI ends up being a little bit less. And that's typical. And I see that often, and we're always looking for that. That never happens with net lease property. This one was $175,000 for a 5-plex. 4.09% cap rate, built in 1968. I don't know anything about the condition, but they're saying that there's upsides in rents. My only question when I start seeing 23% upside in rents is there's probably long-term tenants. And it says no rent control. But the point is, this is in California. So January 1, guess what? There will be rent control. Now, we also pulled up a Denny's. Again, Dusty pulled this up at exactly the same time. And this was a 22-unit franchisor, or franchisee, excuse me. The franchisor is Denny's corporate. And I believe we met this franchisee. We went to one or two of Denny's conventions, and I believe we met this franchisee. Either way, they own 22 different Wendy's. They've got a long-term track record for success. They signed a brand new 20-year lease with rent increases. And it's an absolute triple net lease property. And check out the vehicles per day, 35,000 vehicles per day. And it's right next to a mall and retail tenants. It's in a good location. 1.8 million, a little over that, 5.25% cap rate, and a $95,000 net operating income. This is, this is over 1 percentage point higher, or 116 basis points better to buy this property versus the previous 5-plex in this slide. When you stack them up side by side, to me, there's no question, especially in the highest priced apartment market we've seen to date in history. 5% cap rate versus a 4. The Denny's actually cost you less dollars to get into, and it's going to give you a net operating income. And guess what your responsibilities here are? Well, over on the 5-plex side, your responsibilities are taxes, maintenance, insurance, management, garbage repair, managing the manager, or managing the property yourself. Over here on this side, yeah, you got to go collect that rent every month, either from your mailbox or the wire into your account. You got to get the certificate of insurance once a year. And twice a year, you got to make sure the taxes are paid. When I say you got to make sure, Denny's handles that. They get it to you long before it's ever due or late, as a typical rule. I can't promise everything all the time, but these franchisees, especially when you get up into 22 units, and we get into some of this in the book. So a lot of this details I'm going to give you in the book, and I didn't want to take up too much time in this. So what this exchange just got you, let's say you owned that 5-plex that's on the market right now, and let's say that you bought that Denny's. Well, what that got you, if you were buying it with cash, was $347,000 in boot. Now, unfortunately, folks, you have to pay your capital gains and your depreciation recapture on that $347,000 in boot you took. But let me ask you something. When you're making significantly more income, I have a lot less problem taking the boot if I make significantly more income in what I would buy without getting the boot. This is a 20-year lease. You got rid of all of the owner responsibilities, or most of them, and you insulated your equity from the volatile movements that tend to happen in multifamily as much as anyone can without a crystal ball. But typically we see that the retail moves a lot less volatilely than the single-family home or the duplex, triplex apartment market. Where do you find some of these? Well, you can go to propertyline.com, LoopNet, CoStar. There's all sorts of engines out there that have commercial property in them. And I do suggest, if you're considering this, yes, I do think that you need a real estate professional in your corner, but you certainly should be looking at these and starting to kind of figure out what these properties are that are out there. You don't want to bury your head in the sand either. So these are some great sources that you can use. I think we cite even some more in the book. What you should know right now, you should have an idea based on what I did. If I did this at all well, and I hope I did, and if not, just let me know, and I'd love to take any criticism. And again, I do apologize for our very, very rough start that we had. We were about 10 to 15 minutes late beginning this thing. And we had some technical difficulties that we still don't exactly know why they happened. So how net lease or single tenant net lease works, make sure you read the book. I'll email you a copy of the book. You've got my text where you can text that to my cell phone, or you can go on to the website I gave you to take a look at that as well. How to take advantage of this market. You should have heard some stuff that will tell you kind of how to take advantage of this market. And when we work with folks one-on-one, we can sit with you and give you a much better idea of what everything looks like for you, because we do have to tailor it for your specific needs. And you've got an idea of where you can start searching. LoopNet, Properline, CoStar. These are some great places to go ahead and start looking and see what you can find out there. What do you need to do? What qualifications are we looking for from our clients? And frankly, we have some. You probably, a perfect client for us probably currently owns some kind of investment property, or they have cash on hand that's available to invest into some kind of investment or rental property. And they have a genuine interest in either growing their wealth, their portfolio. They have a return in mind. They have a goal in mind. They have an end result in mind at what they want to get out of their investments. That's really the qualifications of what we're looking for to work with some folks. And again, if you want to know more about Dusty or myself, you can always go to veritascapitalinvestmentgroup.com, and that is located right there. By the way, if you go right to that website, there's also a link directly to grab that ebook as well. You can go there. You can click on contact and classes. If you go click on contact us and classes, and I'm sorry, I'm getting tongue-tied this morning. We have a spot where you can sign up for a 10-minute consultation where I can get on the phone with you, talk about your specific situation, and we can kind of make a decision if we want to move forward with each other after that 10-minute conversation, and maybe I can answer some questions that you just might have in your mind. Feel free to schedule me for that. Even if you have a specific question and maybe you've got your rentals, but you're not ready to do anything right now this year, feel free. If you're just doing some investigation, I am not the type of person who's automatically going to assume that the moment you call me, you're going to sell something and buy something. That's not how I run. That's not how I roll. So feel free to sign up for a 10-minute initial consultation at veritascapitalinvestmentgroup.com. Go under contact us in classes, and you'll be able to just schedule me, and I would love to see you guys there. I really appreciate everyone's time and effort for not only attending today's webinar, but having the patience to wait for us to begin it late, which almost never happens for a lot of the stuff we've done. So thank you for your patience with that. And if there's anything that I can do for you, shoot me a text. Let me know. Maybe we can help you. Thank you very much for your time.